how the elites have mastered the art of generational wealth and creating a lasting legacy, but more importantly, how you can do the exact same thing for your family. I'm Casey Chauhan, founder of togethercfo. Let's go. Let's start with number one, shell companies. Shell companies can be created to hide assets and create more privacy, ultimately. This can happen both nationally and internationally in a whole variety of different types of company. But this year, 2024, FinCEN regulations have kicked in where you have to register with the government, telling them who set up the entity, who owns the entity, who controls everything. So it's made privacy a lot more difficult onshore in the United States, but that isn't the case overseas. So bear that in mind when you're creating your whole plan. And I would encourage you to think 360, multiple generations when putting a plan together. Don't just think linearly, because you're going to create a lot of wealth and you want to pass that on in an efficient way. If you don't pass it on in an efficient way, you could be taxed up to 50% of that. That means all your life you worked really hard to make all this wealth, half of it is gone. So if you live to 70 years old, 35 of those years would be worthless because you gave them back to Uncle Sam. So be really clear on what you want to achieve, and we're going to go over some great ways to do that. But stick around till the end, because my favorite one is right at the end. So we touched on it a little bit with shell companies can be both offshore or onshore. Recently in the news, we've heard about big superstars like Lionel Messi or Shakira having issues with their government. What's happening here is that they're getting money and they're pushing it all over the globe through their structure, either legally or illegally. The government is saying it's illegal, they're saying it's legal, and they've followed the rules. The rules can be very difficult to understand, so always work with a professional team or multiple teams if you're in multiple jurisdictions. So what happened with those guys is that they're receiving money nationally and internationally. And Shakira's case, she was claiming that she spent over 181 days outside of the country, so that changed her tax residence to an offshore jurisdiction, which it was very low. The government did an investigation, realized that wasn't the true case, and then slapped her with a huge fine, and I think they've settled by now. Similar thing with Messi, but a lot of this was leaked out during the Pandora Papers and the Panama Papers, which shows lists of tens of thousands of famous people, billionaires, oligarchs, royalty, were all on this list, showing you exactly how they are set up, which entities, which jurisdictions, and most of that was all done legally. So it shows if you set these up in the correct manner that you can get down to a very significantly low tax rate, even if you are domestic in the US, because those Pandora Papers and Panama Papers actually showed the US as one of those biggest tax havens. So if you set up right and you know how to do it, and you have the team that can help you operate it, you can get actually one of the biggest benefits right here in America. That leads us to the next point. How do you get a team to do it? So when we look at the elites, they all have family offices. So what is a family office? How does it work? What does it mean? A family office is a team of individuals, usually brilliant, top of their game, elite professionals. So as an example, if you look at the CPA that you work with right now, likelihood is that CPA has hundreds, if not thousands, of other clients. If that CPA was working in a family office, he would have just one client, and that would be the family. Multiple family members, but just one family. So imagine how much more benefit that family would get if they had that amazing CPA dedicated to their family 40 hours a week, every single year, year on year. And then that same principle is then applied to insurance, HR, investing, stocks, wealth, every facet that the family is involved in. They would have a player in their family office that deals with that for the family. And they don't have hundreds of other clients. Their client is just that one family. So it creates, like, think of King Arthur and the table of the knights. Amazing individuals sat around the table focusing on the success of this one family. That's what a family office is. What do they do? So all these elite professionals, what do they focus on? So the main things that go on in a family office is setting up very unique structures. It could be trusts, definitely going to include life insurance, but my favorite, and the one thing that we've seen across across all billionaires and every single elite family is a foundation. They all end their bottom line of their legacy planning with a foundation. And this is usually not a typical for an operating foundation. This is very, very specific. This is a private family non-operating foundation. I'll say that again. Private family non-operating foundation. And there's a really good reason for that. Because if you're an operating foundation, you have to go out and seek donations. If you're a non-operating foundation, it's the family that are donating into that foundation, getting a tax deduction, whether it's through a trust, LLC, or personally, and then controlling the money in the foundation. So let me just say that one more time so it sinks in a little bit more. So you're creating all this money in multiple different businesses, beautiful, diverse portfolio, doing great. That then goes through either trusts, LLCs, S Corps, or C Corps, some kind of business structure entity, depending on what asset type it is, and gets donated to the family private non-operating foundation. Because that can get a full tax deduction if it's structured correctly. You get 100% of the right type of assets done in the right way. Then the family foundation is a tax exempt 501c3. It's its own entity, tax exempt. But the family retains full control over that foundation. Full control. So even though you've donated it and gave it away, you've taken a tax deduction on one side, but on the other side, you fully control that asset. The beauty about these foundations is you can hire family members, you can develop leadership within the family members, you're going to protect assets, you're in a much lower tax rate. So even though these foundations are tax exempt, there are two scenarios in which you would have to pay tax. That is if you have an unrelated business income, which is currently taxed around 21%, and the other one is net investment income, which is really important and actually super low. So if the foundation makes money on an investment, let's just use a stock, let's use Apple. Say you buy Apple at $100 the 1st of January and you sell it at the end of December for $150. You've made $50 gain. That gain is taxed at 1.4%. Say that again. The gains are taxed at 1.4%. So this is net investment income, is what they call it, NII. And that's really beneficial because if you did that personally, you'll be paying around 37+% depending on which state you're in and how that is calculated. So by having this foundation piece at the end, you can effectively take your tax rate down from the high 30s or 40s down to 1.4% if structured correctly. Now, it's not all sunshine and rainbows. There's a lot of red tape. There's a lot of administration that you have to adhere to in order to stay compliant with the foundation rules. There's a 5% expenditure rule. There's disqualified people. There's self-dealing. The laundry list goes on and on. Make sure you reach out to a professional to make sure you're always in compliance. But it is by far my preferred structure of choice because of the benefits it gets. Not only can it help create generational wealth, preserve it, but it creates a lasting legacy for you, your family, future generations, all while getting a tax reduction and doing better in the community. The whole point of having these foundations is that you do strategically give to charity, right? When we look at the billionaires and the elite, they have this giving pledge, which they're going to give away 99% of their wealth. What that really means is they're going to take a tax deduction for 99% of their wealth and they're going to control it on the other hand. Yes, they will do a very small percentage of good, but they are using their foundations for influence, power, and control, whereas you could use your foundation for legacy planning, for actually making a difference in the community and passing on that knowledge to your future generations. So if that's something you're interested in, hit the link below. I'd love to get on a call with you. I'm Casey Chauhan, founder of Together CFO. Peace out.